Thursday, 3:26 in the afternoon. You are sitting in a glass office with $842,000 spread across 3 accounts, and a man in a navy vest is explaining why you are not quite ready. Not broke, not careless, not invisible exactly, just below the line. He calls it a firm minimum, $1 million in investable assets. He says it gently, like the number might feel less insulting if it arrives in a soft voice. Your 401k has $611,000. Your brokerage has $184,000. Your emergency fund has $47,000. You have spent 14 years doing the quiet things people tell you to do. You saved the raises. You ignored the car. You kept the old kitchen table. Now, when you finally ask for real advice, the door opens 6 inches and stops. Across town, your coworker Devin has $1.2 million after selling company stock. He met the senior partner this morning. Coffee in porcelain cups, a printed plan with his name on the cover. You got a brochure and a calendar link for a junior associate. You are the same careful person you were yesterday. The number beside your name is almost enough. Almost is where the industry makes you feel poor again. At 25, advice looks like a folding chair in the back of a bank branch. You have $9,400 in a savings account and an old 401k from a job that renamed your position twice before laying you off. A woman at the counter says someone can help you invest it. She points to an office with a fake plant and a framed certificate from an insurance company. The man inside is named Cole. He shakes your hand too hard. He asks about your goals, but his eyes keep moving to the balance line on the form. $9,400 is not a relationship. $9,400 is a transaction. He tells you cash is losing value. He is right. Then he slides over a permanent life insurance illustration with columns that stretch 40 years into the future. You are single, you rent, nobody depends on your income. The product does not fit your life, but it fits his compensation grid. You ask about fees. He says there are no direct fees. Direct is doing a lot of work in that sentence. Somewhere in the paperwork, commissions are hiding under words like premium, surrender schedule, and illustrated value. You leave with a glossy folder because leaving empty-handed feels rude. That is the first thing you learn. Before you have enough assets, some advisors do not see a future client. They see a product slot with a pulse. At 31, the balance is $43,000. It came from 4 years of contributions and 1 market year you did not understand but benefited from anyway. You get invited to a retirement dinner at a steakhouse near the freeway. Free meal, no obligation. The postcard says fiduciary in small print and financial confidence in large print. You sit with 18 strangers under dim lights. The speaker, Victor, uses a laser pointer on a slide, showing a couple walking on a beach. He talks about volatility, inflation, taxes, and the danger of doing nothing. The danger is real. So is the stake. That is how the room works. A true fear sits beside a sales process, and by dessert, the two begin to look like the same thing. A week later, you meet him. He recommends mutual funds with a front-end load, 5.75%. You do the math later in your car. On $43,000, the cost to enter is $2,472 before the money has earned $1. He also mentions an annual expense ratio because the fee does not end after it enters. It keeps walking with you. Victor is not a monster. That is the uncomfortable part. He knows more than you. He asks decent questions. He also works inside a machine that pays him when you move. Before your account is large enough to be managed, it is large enough to be harvested. By 34, you have $118,000, and a new distrust of anyone who offers dinner before disclosure. You choose the machine instead. A robo-advisor charges 0.25% a year. On your balance, that is $295. Less than 1 hour with some attorneys. Less than 1 bad decision at the steakhouse. You answered 12 questions on a screen. Age, income, risk tolerance, time horizon. The machine gives you a portfolio of low-cost index funds and rebalances when things drift. There's something clean about it. No vest, no smile, no framed beach couple, just code, allocation, and a fee schedule you can understand. When the market drops 11% in October, the app sends a message about staying the course. It sounds cold. It is cold. but cold is not always bad. Cold does not pretend to care while reaching for your pocket. Still, you feel the limit. Your mother asks whether she should claim Social Security early. Your app has no chair for her. Your partner asks if buying a duplex would ruin the plan. The app gives you an article with bullet points and a stock photo of keys. You read it twice and feel alone in a more advanced way. At this stage, the industry has solved one problem and left another untouched. It can invest your money cheaply. It cannot sit across from you when life becomes more complicated than a questionnaire. At $247,000, human beings return. Not the senior ones, not yet. But someone answers. Her name is Mara, and she works for an advisory firm with brushed metal letters on the door. She explains assets under management. 1% per year, billed quarterly, on $247,000. That is $2,470 a year. A real fee. Visible, cleaner than a hidden commission, but not small. Mara asks about your emergency fund, your tax bracket, your employer match, your Roth eligibility. For the first time, advice feels like a map instead of a product. She tells you not to roll the old 401k until you compare the investment options and fees. She says paying off the 6.9% student loan might be smarter than chasing market returns with money that belongs to anxiety. You write that down. Then she mentions the firm's minimum is usually $500,000, but they are making exceptions for growing professionals. Growing professionals. A polite phrase for people not profitable enough yet, but promising. You become aware of yourself as a seed account, someone they will water lightly until you become worth the sunlight. At dinner, your friend Nia says she finally hired an advisor too. He put her into 3 funds and calls once a year. She thinks that is normal. You almost explain the difference between planning and placement. You do not. People defend the person who made their confusion feel handled. This is the second lesson. Good advice exists below $1 million. It is just harder to separate from attention that is waiting for you to become larger. At $430,000, the calls change after your father dies, and a rollover lands in the account. Grief comes with paperwork. That is one of the smaller cruelties. You are sorting hospital bills, a death certificate, and a beneficiary form when 2 advisors you barely remember suddenly remember you. One leaves a voicemail saying this is a critical transition. Another sends an email with the subject line, protecting your legacy. Your legacy is a shoebox of old photographs and $183,000. Your father built one paycheck at a time. The word feels too polished for the kitchen you're standing in. A man named Ellis recommends an indexed annuity. He says downside protection. He says market participation. He says lifetime income. All true in the narrow way sales language can be true. Then you find the surrender schedule. 10 years. Charges if you leave early. Caps on the upside. Complexity wrapped around fear. The product may fit some lives. It does not fit this moment. This moment needs clarity. Taxes, beneficiaries, and someone patient enough to explain why your father's cost basis matters. You find an hourly planner instead. $350 an hour. 2 meetings. A written checklist, no assets moved. She tells you which accounts to retitle, which forms to file, which questions to ask your CPA. The bill is $1,050. It feels expensive until you realize she did not need your money to stay with her to be paid. Before $1 million, the cleanest advice is often the least romantic. A fee, a clock, a person who can walk away after telling the truth. At $678,000, you are suddenly big enough to be interesting and still small enough to be sorted. Mara invites you for an annual review in a conference room you have never used before. There is sparkling water on the table, not for luxury, for signaling. The firm has begun rehearsing a better version of itself in front of you. Your portfolio is up, your contributions are steady, your life has become complicated in profitable ways. Stock options at work, a taxable brokerage account, a mortgage you refinanced when rates were lower, a child on the way. Now advice has texture, asset location, term insurance, 529 plans, tax loss harvesting, whether your cash earns 4% in a money market or sits in checking because inertia is lazy and profitable for someone else. Mara brings in Caleb, a senior advisor for 22 minutes. He says congratulations twice. He asks what keeps you up at night. You say honestly that you are afraid of making one mistake large enough to erase the last 15 years. He nods with practiced gravity. Then he says, the firm has deeper planning resources for households approaching $1 million. Approaching. The word does not mean there. It means visible from their side of the fence. On the way out, the receptionist uses your name without looking down. Small thing. Almost nothing. You notice anyway. At $678,000, the advisor does not chase you. But they stop letting you drift. They know the math. 1% of your account is $6,780 a year. If you become $1 million, it becomes $10,000. If they keep you for 20 years, you are not a client. You are an annuity without the surrender schedule. At $941,000, the line begins moving toward you. You have not crossed it. The firm can just smell it. Your bonus posts in February. Your restricted stock vests in March. A market rally adds more than your first yearly salary in 6 weeks. The number is still not $1 million, but it has begun behaving like an invitation. Caleb emails personally now, not through Mara. He suggests a second opinion on the company stock concentration. He offers to loop in an estate attorney. He mentions charitable giving, even though the largest gift you made last year was $500 to the food bank after a storm. The conversation has changed from what you have to what your household could become. That Saturday, you meet your cousin Theo at a hardware store. He says his advisor never calls back. Theo has $62,000 and a rollover question. He shows you a screenshot. 3 messages unanswered. You look at the screen and feel the old version of yourself standing beside him. The industry did not become wiser as you saved. It became more available. At the review, Caleb shows you a binder thick enough to feel serious. Retirement projections, Roth conversion windows, equity compensation, umbrella insurance, beneficiary gaps, cash flow, things you actually need, things nobody would have built for you at $43,000. He is helpful. That is the difficult part. The better treatment is not fake. It is just rationed. Before you leave, he says, once you cross 7 figures, a few more doors open here. He smiles like he is giving good news. You smile back like you did not hear the lock. 3 months later, your account closes at $998,740. Not $1 million. A rounding error away from being treated like a different animal. You sit at the kitchen table with your laptop open and a cold cup of coffee. There is an email from Caleb, sent at 7:42. Subject line, Private Wealth Introduction. You read it twice. The firm has not changed. Caleb has not changed. Mara has not changed. The certificate on Cole's wall. The steakhouse slide. The robo-questionnaire. The hourly planner's invoice. Theo's unanswered messages. All of it belongs to the same quiet map. Advice was never distributed by need. It was distributed by revenue, liability, and whether your balance could grow into something worth defending. That is not cynicism. It is the business model with the lights on. You think about the version of you at 25, holding a glossy folder in a bank parking lot, wondering why help felt like a trap. You think about your father building $183,000 slowly, without ever being called legacy until the word could be sold back to you. You think about Theo, still waiting for a reply because his question is too small to ring loudly. Then the market opens, the number moves. $1,213. Your phone buzzes, another email, Caleb again. He says, congratulations, you do not feel richer than you were 5 minutes ago. You feel categorized. Somewhere right now, someone with $18,000 is being sold certainty. Someone with $80,000 is being given a portal. Someone with $400,000 is being called emerging. They think they are looking for advice. They are really discovering their price. Before $1 million, financial advisors do not ignore you completely. They measure what helping you might become.